Well, greetings and salutations, Series 6 test takers. This is Dean Tenney coming to you from my studio here in fabulous Las Vegas with a shout out to KnopmanMarks. They are giving you a free look on their quality content by giving me permission to explicate that for you. On our channel, one of the most common things people like are practice tests. And what better practice test than one from KnopmanMarks? You can see if you like their style, I'll put a link with a discount code and a link to their Series 6 product, and you can check it out there. What you should be doing is hitting pause, attempting your answer, hit play, and then listen to me explicate the right answer. And if it's worthwhile, talk about why the wrong answers might be right to different things, but are wrong to this, perhaps this question. All right, let's dive in. Which of the following inventory accounting methods would most likely produce the highest costs of goods sold and lowest net income during a period of rising prices? So, usually if you think about it, I always think you should think about these as business accounting questions from your personal perspective. And it says lowest net income. Usually the things I buy later for my inventory are going to have a higher cost than the things I put into my inventory earlier, right? I'm coming to you when we're in an inflationary environment for eggs, for example. And so if I sell eggs, the last eggs I bought are the highest prices on the ones I'm selling. Now that's a little off because it's perishable, but you get the idea, right? So the answer to this question is LIFO. Now I'm not sure, I think that's personally, my personal commentary would be pretty high end kind of a question for Series 6, but every draw of the test is a little different. So who knows what draw you'll get. I'm wishing you a dream draw. Everything you studied shows up and you go, I don't know what the big deal is, but got to be prepared for a face of death draw as well. All right, number 2. An investor exchanges mutual fund shares held in a non-retirement account from a fund in one fund family to a similar fund in a different fund family. The consequences of this transaction include all the following. You should definitely know this is a taxable event. So this exchange takes place at NAV. The consequence of the travel following except. No, it doesn't have to. A lot of funds will offer you that privilege, but it's a privilege. It doesn't have to be offered. So it could be very well be at the public offering price. The transaction is treated as a redemption, a sale, and repurchase. That is true. The biggest takeaway for test purposes is a taxable event. Any capital gains or losses must be recognized when the change occurs. Yeah. B and C are saying it's a taxable event. The taxation of any gain or loss is based on the investor's holding period. That is indeed true. Remember, to qualify for a long-term capital gain, you would have had to hold those shares for more than 12 months. So the answer is A. 3, in which of the following types of brokerage accounts may customers use margin, borrow funds, and run a debit balance? Wow. You should definitely know you can't do that in the Uniform Gift to Minors Act or Uniform Transfer to Minors Act. Very testable, no margin. Can do it in 529s. Yes, corporations can do that as long as it's when the corporate charter specifically permitted. And so C is true. And retirement accounts are typically, traditional IRAs are typically cash accounts. The two basic types of accounts at a brokerage firm are cash accounts where you intend to pay in full, and margin accounts where you intend to pay part of the purchase price. And what we're basically saying is that these custodial accounts, 529s, IRAs, those must be cash accounts. All right, number 4. All the following are characteristics are shared by open-end and closed-end companies, except it is very testable to be able to contrast an open-end fund with a closed-end fund and how they're alike and how they're different. So I like this question, very testable. All right, so now we got to be careful here. It says except. So we're looking for the thing they don't have in common, and that is fixed number of shares. Open-end funds are continually offering new shares to the public. Closed-end funds have a fixed number of shares. That is how they're different. Remember, this is except, and so that's what they're asking us. Both are classified as management companies. That's true. Both will have a daily calculation of the NAV. That is true, but it wouldn't matter to the closed-end fund in this regard in terms of redemption, because you wouldn't be redeeming, you'd be buying or selling based on the secondary market supply and demand. So C is true. D may be sold through broker dealers. Yes, if I have a Series 7, I can offer both versions, and brokerage firms do. So the best answer there is A. I would just elaborate and tell you, make sure you can really contrast those two. Number 5, a customer's divorce settlement specifies that a joint account must be divided evenly into 2 individual accounts that will be held with your firm. This instruction requires which of the following? Well, we're not really going to have to go outside our firm. We don't need a limited power of attorney because we got it from the court. ACAT, no. Transfer instruction form, no. Based on that answer set, our best answer would be an internal transfer form. We can do that internally. Number 6, FDIC covers losses in each of the following types of products offered by banks except. Well, so what this question is really asking you is that one of these things is not a banking product. One of these things is a security. And FDIC does not cover securities. And a money market mutual fund is a security. That is a mutual fund that buys high quality debt maturing in less than 12 months. So the answer is A. It does cover checking accounts, interest-bearing accounts, CDs, and that maximum coverage is 200 and was it 250 or is it 200? It's one of the two. 7. All the following investment alternatives, which would could be. Now this is grammar. Of the following investment alternatives, which could be expected to have most stable value? I kind of like this question. What this question is getting at is that a money market has a fixed NAV of $1 per share. No wonder people get confused with money market funds being like a checking account because, that's how we sell them. I would tell you that's for retail money market mutual funds. I don't think it's a testable distinction, but I would know that a money market fund has $1 stable NAV. 8, there are 2 situations that show up on the exam. One is this situation where they give you the NAV and the percentage sales charge and ask you to recalculate or calculate the public offering price. And that is what this is doing. The other situation is where I give you the NAV and the public offering price and ask you to calculate the percentage sales charge. This is important enough that I'm going to go ahead and get out my annotation tool and show you how we go about answering this question. So what we're going to do is we're going to take the NAV, which is $7.82, and we're going to divide by 100% minus the sales charge. So 1 or 100% minus 8, which is 92% or 0.92. And that would give us the answer. So now I'm going to take my calculator and I'm going to take 7.82. I'm going to divide by 0.92 and I get 850. And then what I want to do, oh, look at this. Dean almost missed this question. And the reason I missed the question is now I go back and I look at my answer set and it doesn't offer that to me. Right. So I say, uh-oh. And then I have to reread the question. Ms. Johnson paid a sales charge of, okay, well, now what I got to do is I got to do one more step here. 850 minus, what was it? 782. And now I have the answer, hopefully. 850 minus 782 equals 68 cents. Boom. Now, by the way, as I told you, the other one they might have to do is you might have to actually do this the other way, which is to take the 850 and 782 and determine the percentage sales charge. I just got permission recently to do this for Knopman, so I haven't actually looked over this practice test, and we'll see if we run into that, encounter that. If not, I'll try and remember at the end of this to show that to you, or if you're watching this, just to, hey, Dean, you said you were going to show it and you didn't. Could you show it? We'll see. I wouldn't be surprised if we bump into that second scenario here somewhere. All right, so let's clear this. The answer there, whoa. The answer to that was 68 cents. All right, number 9. and a joint tenants with rights or survivorship account. So again, another very testable thing to be able to do is to contrast joint tenants with rights or survivorship with tenants in common. So that's definitely something you want to be able to do. At death, the account proceeds pass the estate. No, that's true of tenants in common, not joint tenants with rights or survivorship. Very testable. At death, the account proceeds pass the joint owner. Ding, 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 ding. That's true. We need Roman numeral 2. Joint owners have an undivided interest. Yes, both parties own 100% of that account. And tenants in common, there is a fractional interest, but not in joint tenants with rights of survivorship. That is very, very much a testable concept. 10. Which of the following statements is true regarding a mutual fund account with a transfer on death designation? This designation can only be used in conjunction with joint accounts. No. Account of this designation is subject to probate. That's no, right? That's not true. We're looking for something that is true. Either the account owner or beneficiary may make trades in the account. That's not true. So A is not true. B is not true. C is not true. So I guess it's D, the beneficiary. Yeah, after they get the account, they can come after them. So it doesn't attract, it doesn't protect you against creditors, the person who's the transfer on death. Acme Fund has, what is the public offering price? Well, I think we did this just a little bit ago, but it's very testable. I'm looking for that second scenario. As I told you, 2 scenarios, math-wise, you can't be fumbling around with. You can't be fumbling around with this one. When given the NAV 920 and the sales charge 8%, calculate the public offering price. That's what I'm about to do. The other one you can't be fumbling around is when given the public offering price of the NAV, calculate the percentage sales charge. And by the way, we should know that percentage sales charge can never be more than 8.5%. So as you recall from the previous example, I hope, or at least you recall before your test, because, oh my goodness, you don't want to be on the test and not be able to perform a math question. There's no interpretation on math question what the right answer is. And remember, what we're going to divide by is 1 or 100% minus the sales charge. So 100 minus 8%, 100% minus 8%, 1 minus 8%, 0.92. And that equals $10. Again, very testable to be able to do that, be able to do that math. All right, let's get rid of that. The NAV, they love to confuse you about what causes the NAV to go up or down. And what you want to stay focused on is the value of the portfolio going up or down. So shareholders reinvest dividends and capital gains distributions? No. Right? Because that's a wash, right? There's more shares, but there's, the assets are going up by the exact same amount. The division of the shares are going up. Capital gains of the funds are distributed. No, that wouldn't cause an increase. Right? Increase means we need the value of the portfolio to go up. C, the fund receives interest from bonds that are held. Yeah, that means now the fund has more cash than it used to. And so indeed, the portfolio has gone up in value. Boom. C. Again, it's a wash when people redeem their shares. There's no change in the value of the portfolio from redemption. So you got to think of, when you get this kind of a question, you got to be thinking about what's going to make the portfolio go up or down. Up or down. Here it's going, it says up. We need to know what's making it go up. 13. An investor would like to achieve monthly income from a mutual fund that has the highest level of principal protection. The minute you see highest level of principal protection, you should think U.S. government securities. There's no better credit quality than that of the United States government. So a suitable recommendation would be a U.S. government bond fund, right? Money market I think of a money market fund as a parking spot for your idle funds, not so much something you do to achieve your investment objective. High yield bond fund, you have credit risk because they're buying less than investment grade bonds, and a balanced fund would have a little bit of both. So that would be a D. 14, the benefit of a 1035 exchange is that any growth in policy value of the exchange will be taxed at capital gains instead of ordinary income tax rates. The new contract will be issued with without a new sales charge. The new contract will be issued without surrender charges. Any growth in the original contract is not taxed at the time of the exchange yet. I would think you could expect a question about a 1035 exchange. So I'd be prepared to have at least one question on that on your exam. The tax liability in a custodial account lies with the minor. The kid's tax ID number goes on the account, very testable. So tax liability in the custodial account rests with the minor. I'd also know the minor's tax ID number goes on the account. And then remember, we can't use marginal. That's very testable. I'd also know you can only have one minor, one custodian per account. One minor, one custodian per account. 16, the excess of a put's option strike price over the underlying stock market value. I think our friends at Knopman are being a little difficult on this one. I don't know if they're taking advantage of that. Most of you in your SIE probably remember call up, put down. And so put down is the same thing as saying the market price is above the strike price, right? So the excess of a put strike price over the underlying stock, that's called intrinsic value. I'm not so sure how worried I would be about options on your Series 6. We'll see how many more we encounter in this practice test. But if you tell me you missed your mark on the 6 because of options, I'm going to say, yeah, you have bigger problems elsewhere. An investor who makes a secondary market purchase of a closed-end fund share or company shares would most likely pay which of the following. What this is getting at is it trades like a stock in the secondary market. So that would be a brokerage commission. A contingent deferred sales charge could be for an open-end mutual fund of some sort. A mortality charge, that has nothing to do with mutual funds. Sales load, no, you don't pay a load. Load, again, would be based on an open-end mutual fund, A shares, B shares, C shares, etc. So brokerage commission. 18, the value of a variable annuity accumulation units. I think of a variable annuity as a mutual fund with an insurance wrapper. Certainly don't tell your compliance department that's what Dean said, but in terms of passing the test, I would think of a variable annuity as a mutual fund with an insurance wrapper. And instead of having shares, what you have are accumulation units. And so, if every time you heard variable annuity, you said mutual fund with insurance wrapper, and every time you heard accumulation units, you said shares, you'd be in pretty good shape. So let's say accumulation units are shares in the separate account known as the mutual fund. That's what the separate account is, the mutual fund. So every time I heard separate account, I'd say mutual fund. It's fixed. No, it is not. Just like in a mutual fund shares, right? Accumulation units are not fixed. It's determined by a formula specified in the annuity contract. No, it fluctuates based on the performance of the mutual fund, the separate account, indeed. So again, my recommendation for you vocabulary wise, when you see variable annuity, mutual fund with insurance wrapper, separate account, mutual fund, accumulation units, shares. Most of these kind of questions are camouflaged mutual fund questions. So the answer here is C. I would be prepared for variable annuity questions. So make sure the versions that are using after-tax money, non-qualified variable annuities, the type that are using pre-tax money, 403Bs, 501C, TSAs, tax sheltered annuities. So you'll get a handful of those. So be careful, be aware of that. An employer offers a simple IRA plan and makes matching contributions for participants. If an employer earns compensation of $100,000 and defers $5,000 into the plan for the year, what matching contribution must the employer make? So an employer who elects to manage must match 100% of the employee's deferrals up to 3% of their compensation. So 3% of the compensation here is going to be, it's the lesser of, by the way, $3,000. So the answer is A. Common stock is most often purchased to satisfy which of the following investment objectives? Common stock is most often used a purchase to satisfy which of the following? Yeah, you should definitely know growth, right? You're owning a business is growth. Income would be primarily bonds or stocks that pay dividends. And it doesn't say that. It says following satisfy growth, right? Tax minimization would be maybe a community bond fund. Principal protection would be something different. A customer is forced to apply for a 401k hardship withdrawal to pay for his daughter's college education, daughter's college tuition. How will he be taxed on this withdrawal, assuming it is used for qualified educational expenses? Well, it's going to be fully taxable, but it's no penalty. Now, I don't know if Knopman has received this on debrief, and that's why they got a practice question that there's something about this. I haven't had anybody tell me they've seen it on their Series 6, but hey, that doesn't mean it's not there. 22. Which of the following functions is not typically associated with the role of a professional manager for a mutual fund? So they're asking what the professional manager does not do. Does the manager monitor the performance of the portfolio and adjust as necessary based on the investment objective? Absolutely. Providing clearance and custody that are integral to the maintenance of the fund? No. That would be somebody else. The custodian of the mutual fund is different, and clearance is, doing the trades. That would be a broker. Those are different functions. Engaging in research necessary to make optimal selections? Absolutely. Selecting the securities to be included? Yeah, that's one of the number one reasons to buy a mutual fund is professional management. Professional management, diversification, and ease of ownership. So the answer 22 is B. A registered principal, that's your supervisor, is required to review a variable application, submit it to the issuing insurance company within 7 days of receipt. That's a recognition question. Suitability is really important in variable annuities. So the answer is D. The price at which a fund sponsor sells mutual fund shares to the public. I like this one. You got to be real careful with that, right? The public offering price, very testable. So it's the NAV plus the sales charge, not a commission, sales charge. Commission, for exam purposes, that commission means something different. You could think of that, but it's the public offering price. So it's the NAV plus the sales charge, which equals the public offering price. Really make sure you're comfortable with the NAV and the public offering price and that percentage sales charge. 25. Which of the following unit investment trusts? I highly recommend that you always spell out any acronym you encounter. So I see UIT, I'm going to say unit investment trust. Which of the following unit investment trust is most generally associated with clients seeking current income and safety of principal? So almost every time we see this current income and safety of principal, it's going to be a U.S. government kind of something, right? So the answer here is B. B. Require minimum distributions do not apply. That's very testable. Yeah, it's one of the things that gives the Roth IRA its juice. I think those things are so juicy. I think I would be prepared. If I were in charge of the test, I'd write a legislative risk question. Senator Roth is no longer around to protect the Roth IRA. And, it's sweet. And one of the biggest distinctions is just that, right? There is no required minimum distributions, right? So others, remember, you have a required minimum distributions on most other types of plans at 73. I would definitely know that, very testable. 27, which of the following is a characteristics of a simple IRA? Which of the following is a characteristic? There are no contribution limits. And after 2 years of participation, participants are allowed to transfer funds to a traditional IRA without penalty. That is indeed true. The three styles of questions you get on the test are recognition, practical application, and judgment. There's very little judgment questions on Series 6, but lots of recognition like this one, lots of practical application. Practical application is like a couple of them we've done, right, where we took the NAV and the sales charge and determined public offering price. Those are practical application. You don't want to give those up either, because remember, there's no interpretation of the answer. You simply get it right or you get it wrong. 28. In a bankruptcy proceeding, the claims of preferred stockholders generally fall below which debt holders? We're all the debt holders, right? I mean, the only thing that the preferred stock is senior to is the common stock. So it's going to be junior to all of the debt. So both secured lenders and general creditors, right? Not secured lenders. It's going to be both. Whoop. So the answer there is B. Which of the following statements correctly describes a shareholder's tax consequences when a mutual fund's dividend distributions are taken in cash? This is very testable. I've had on debrief, many people say they've seen this almost this exact type of a question. So kudos to our friends at Knopman. This is a very good simulation of something you can encounter on your exam. So I tell the mutual fund, I say, look, I don't need the money, so just buy me additional fund shares. As far as the IRS is concerned, I could have had the money and that's the same as getting it. That's called constructive receipt. So I'm going to owe taxes on it. A, there are no taxes due because the distribution represents a return of capital. That's not true. That is not true. Mutual fund dividends are always considered qualified and are subject to taxation at preference rate. That is not true. Mutual fund dividends represent realized appreciation of securities in the portfolio and are subject to taxation capital gains. No. The answer is D. Now, on the test, we might refer to this as a DRIP, a dividend reinvestment program. You know, you might want to consider if you choose to buy the Knopman products, which I like about old-fashioned PDFs, is if you have an old-fashioned PDF like this, you can print it out, and I make it a poor man's flashcard by getting rid of all the wrong answers. And then one thing you might want to do if you have like the PDF of the Knopman content is just the night before or morning of or both, just read the questions and the right answers. I call this a poor man's flashcard I've just created by marking out the wrong answers, because you don't want to be studying the wrong information. You want to be studying the right information. So for what it's worth, you might want to consider that a poor man's flashcard. Which of the following life insurance events is taxable to the recipient? You know, you're not going to get many life questions, but this is certainly one of them. And, you know, we have different kinds of, universal life and variable life. And again, another recognition style question. This is B. The cash surrender value of the policy if it exceeds the owner basis in the policy. And I like that, again, a very good recognition question. So Knopman on this exam has some very good recognition simulations. 31. A commission is most likely payable to a registered rep upon the sale of which of these following products? What are you going to get paid? And it says commission. So we don't typically get paid to help people park their money. Upon the sale of commissions, most likely be paid on which of the following? Class A shares in a mutual fund, most likely payable. A variable life policy or variable annuity contract. I'm struggling here a little bit, and I'm struggling between, B and C. All open-end share classes now, because we have no loads that are open and continually offering new shares. So I'm stuck between the B choice and the C choice, but I'm going to go for the C choice. And I'll find out later if I missed it. If I do, I'll put that in the video description. And I think the A is going to be called a sales load and not a commission. So I think that's maybe the distinction that Knopman is getting at here, but we'll see. Which of the following fees is not an annual cost associated with Class A mutual fund shares? Not an annual cost. So the investment advisory fee certainly is. The administrative fee certainly is. The promotional expense, that's the 12B1 fee, certainly is. No, the contingent deferred sales charge may or may not become an expense, but it's not annual in any case. So the answer is D. There is a general increase in market interest rates. Which of the following statements is true? Wow. The price of a 5-year bond will fall and will fall more than the price of a bond that matures in 30 years. No, Long-term bonds are more volatile than short-term bonds. Long-term bonds are more volatile than short-term bonds. So A is not true because it's saying that the 5-year bond is going to fall more. The price of a 5-year bond will increase. There's no scenario in which bonds are going up as interest rates are rising. So that's false. Remember that inverse relationship from your SIE? The price of a 5-year bond will increase. By the way, you should have been able to get this to a 50-50 pretty quickly by knowing the inverse relationship. D, the price of a 5-year bond will fall, but will fall less. There we go. Than the 30-year bond. By the way, test taking trick, a principle of mutual exclusion. I know the answer is either A or D because they say opposite things and they both can't be true in the same universe. So just knowing that test taking trick, principle of mutual exclusion, I could have got this to a 50-50. Now I'll give you an example of the principle of mutual exclusion. Socrates is a dog. Socrates is a philosopher. He's either a dog or he's a philosopher. He can't be both. He can't be both. An investor wishes to invest indirectly in companies that have the potential to outperform the market. Outperform the market. She's not interested in current income, which of the following mutual funds must be suitable. So, wow. If you're the very nature of outperforming the market means you're going to be aggressive. I mean, because, that's, you're going to be taking some chances. A value fund over the long term, perhaps you should definitely know it's not a corporate bond fund. And you should definitely know it's not a commodity fund. Yeah, I think the best suitable answer there is the aggressive growth fund. Oh, excuse me. 35. An investor in making a $25,000 investment in a high quality growth mutual fund. I think that's a typo. I think that should say is. I'll reach out to my friends at Knopman and maybe they, offer this to me because they're field testing it through explication on our channel. Any case, thank you, Knopman. KnopmanMarks. So, which of the long share class is most appropriate for this? You're definitely going to get this to know that Class A shares are most appropriate for long-term purchases because, you pay that sales charge up front and then you're kind of done with it, right? So the answer is D. Very testable to know those Class A shares, to know the letter of intent in 13 months, can be backdated 90 days. No investment clubs don't qualify. So this is a target-rich environment to know those Class A shares. 36. In the securities brokerage industry, what type of account allows an advisor or a planner to place trades without the customer's prior approval? That's a discretionary account where I can make decisions about action, asset, and amount. So the answer is A. The answer is A. Trading or tracking market trends and trading volumes are most closely associated with which type of analysis? It's going to be technical analysis. Fundamental analysis would be the economy, the industry, the company's balance sheet, its income statement. That would be fundamental. Technical would be charts, trading volumes. At the end of the day, technical analysis uses charts to say, okay, if there's more demand than supply for the stock goes up. If there's more supply than demand for the stock goes down. And, that chart helps me give me the past price performance to help me kind of indicate, what that future demand or supply of the stock is of the stock. That would be, support, resistance, head, shoulders, that kind of stuff. 38. A customer that's recently purchased a variable annuity contract wishes to take an emergency cash withdrawal of 50% of the purchase payments. Which of the following statements is true? Which of the following statements is true? The customer may withdraw the funds through a policy loan provision. No, that's too much. You're only allowed to withdraw a certain amount of money. Variable annuity contracts allow customers to withdraw funds with needed without charge. No. The customer may withdraw the funds, but will be subject to surrender charges. And that's definitely something they need to know about that product, right? So the answer is C. 39. Your 45-year-old client inherits a traditional IRA from his father. It's worth $75,000. He takes a full immediate withdrawal. No part of it is non-tax or non-deductible contributions. So that's important. No part of it is non-deductible contributions. Ted is 45 years old. What will he pay tax on the withdrawal? He will pay ordinary income tax, but he will not have to pay the penalties. The answer is B. Right? So if you don't have to roll it over is the point. And considering the sale of a fixed indexed annuity, fixed indexed annuities are not considered securities because there's no negative reset on them. So let's see, a customer rep must be aware the contract has potential to lose money. Now, if that was the case, it would not be an insurance product. It would be a securities product. There's no negative reset on a indexed annuity, meaning all that means in English is it doesn't go backwards. The customer must be given a prospectus or access to a prospectus. No, because I just told you it's not a security. The contract may cause reduced liquidity due to its surrender charge. That sounds reasonable. Interest will always be credited at the end of each year the contract is enforced. No, that's called point to point, and they can do it, however they choose to. It could be that, but yeah, C is the best answer given that. What I would know is there's no negative reset. No, meaning you get credit and it just continues to go that way. And what that means in English is there's no principal risk. Microsoft is paying a 16-cent quarterly dividend of 16 cents. The stock is trading at 26. This is very much a test question. So there's not much math on the Series 6, but what there is there, you got to be able to do. And the current yield, the way I think of current yield is what it pays you divided by what it costs you. What it pays you by what it costs you. So first trick here is this is a 16-cent quarterly dividend. So that's going to be 64 cents we're going to get annually. And to get that 64 cents, we pay $26 for the stock. This is very much something you should be able to do on the test. So what is the dividend yield? I'm going to take the 64. I'm going to divide by 26. And I find out it is 2.46, which is close enough to say that the answer is C. Now, I don't know if Knopman's trying to be difficult here. What I mean by trying to be difficult is that it would have been easier to say 2.5%. And I think that's what you should be prepared for on the test. But, you can always pick what approximates your LED display. So on my LED display, when I did that, I got 0.024615. And you're just going to round, right? And you can just pick whatever that approximates your LED display is what I'm telling you. So don't get hung up too much on that. The answer is C, 2.5%. What investment attributes are offered by virtually all mutual funds? Well, yeah, I said the reason you buy mutual funds is professional management, diversification, and ease of ownership. Not all mutual funds have a very low cost. Not all of them have tax exempt earnings. Not all of them have low risk, but virtually all mutual funds provide you diversification. And that's important. That means you're going to avoid very testable. You're going to avoid non-systemic risk, non-systematic risk known as selection risk, because you'll be diversified in a mutual fund. That's one major reason to buy a mutual fund. Now you're still going to be exposed to systematic risk or systemic risk, and then you get professional management. Indeed. I had a friend, Clarice. He worked very hard to accumulate $4,000. And she said, Dean, what should I do with this $4,000? I said, do you have the time, temperament, expertise, Clarice, to be managing money? And she said, well, God, no. I said, well, then you ought to consider hiring a professional money manager. She said, I can hire a professional money manager with as little as $4,000. I said, Clarice, there are men and women who have sold their soul to manage that $4,000 for you. What you should do is buy a mutual fund. For most retail clients, this is the best way to access professional management. Other managers might say, hey, our minimum relationship is 500,000. I don't have any mutual fund that has a minimum relationship number of more than, there's probably something even less than $500 you can sign up. An investor with a growth objective and high risk tolerance. Wow. So it sounds like they're pretty aggressive. Purchasing when they have high appreciation potential. So man, this guy's aggressive. For test purposes, I don't really think there's much of a distinction between A and B. But large cap fund would be typically like ExxonMobil or Apple or Microsoft or Alphabet. Those are large cap funds. Blue chip is a mutual fund with companies that have proven track records in good times and bad. When you think of a blue chip in poker, it's the most expensive chip. And so that's what we mean by the blue chip, a proven track record in good times and bad. We should have been able to toss out the balance fund. Now, you're not going to have high appreciation potential because in a blue chip or large cap, I mean, those companies are capable of making billion-dollar mistakes and still being around. So they have less risk because of their size and resources available to them. And they also means, if they make $1 billion, it's, not going to be a big deal in terms of the overall, number of shares outstanding. So given this answer set, it looks like our answer is going to be a microcap fund. A retiree age 81 wants to use the uniform life expectancy table to calculate the RMD. It is kind of an interesting question from a traditional IRA that he owns. In which case, will this not be possible? Well, I think this is always possible. I don't think many people know this is available to you. And the table can be used in all situations. I'm not aware of any situation in which you cannot use this. In other words, instead of taking a yearly withdrawal, you say, I just want to kind of take out, whatever it says I need to have it completely exhausted by the time I die. By the way, the IRS wants you to make sure it's fully exhausted because they want to get tax you on that money that they haven't received taxes on thus far. Assume a mutual fund has a dividend yield of 4%. So 44 is D. 45. Assume that a mutual fund has a dividend yield of 4% in July. By September, its NAV has declined 20%. Now, remember, I said current yield is what it pays you divided by what it costs you. What it pays you divided by what it costs you. By September, the NAV has declined 20%. That means what it's going to cost you has gone down 20%, but what it pays you has remained the same. What will be the impact on the price decline on the dividend yield? Now, I would tell you it's not going to be for somebody already in the fund. That's not going to be the case. But for somebody who's now considering purchasing it, they'll have a higher current yield. I'd be careful about that, in terms of how you explain that to a customer. You don't say, oh, that's okay, your NAV went down because that means the current yield went up. No, that's not true for somebody already in the fund. But for people considering purchasing the fund at a new price, that would be true. The answer is C. What is the annual amount per beneficiary that can be contributed by the owner of a 529 plan without triggering the federal gift tax or generation skipping transfer tax consequences? Kind of an interesting way to say this, but it's 5 times the annual gift. So, I think it's an interesting way they've phrased this answer set. But back when it was 15,000 per, President Obama, at the time, he's still president and the kids were still minors. He said, have you heard of 529s? I was able to put 5 times 15 grand, 75 grand into one daughter's 529 and 75 in another daughter's plan. And then Michelle did the same thing. We were able to take $300,000 out of our estate using a 529 plan. So you can front load this plan 5 times the annual gift tax. Now, again, that number changes, and that's why they don't want to test you on the actual number. I think this 2023, it's going to be 17 grand. But as I said, they shy away from that. Albert set up a 529 plan for his son's college education. However, the son decides not to go to college. Can Albert change the beneficiary from his son to another person? And the answer is yes, absolutely. So you don't have all your eggs in the Albert basket, right? The answer is B. I like Knopman's recognition questions. A lot of these recognition questions are really good fodder for a poor man's flashcard. What legal instrument will a customer execute to give a financial planner discretionary trading authority until such time it is revoked by the person. And that's just called a limited power of attorney. There's no such thing as a notarized advisory contract. There's no such thing as a revocable collateral assignment. Revocable living trust isn't about this at all. So, when do traditional IRA assets technically belong to the beneficiary? Immediately at death, right? They don't belong to the beneficiary until somebody dies, right? So at death. XYZ is trading at $50 a share. It paid a 50-cent dividend. Well, again, I think this is our friends at Knopman just reinforcing this idea that you're going to have to do this math. You need to be able to current yield. Remember, it's what it pays us divided by what it costs us. So 50 cents a quarter is going to be $2 annually. We're going to divide that by what it cost us, which is $50. And when I get my calculator and do that, 2 divided by 50, I get 0.04, it's 4%. But again, they won't ask you on the test to come up with, some odd number. So it is C. Whoop. A customer on May 20th, a customer died on May 20th, leaving her traditional IRA to her 3 children as equal beneficiaries. Her real will instructs her estate to pay all taxes and expenses after her death. If an IRA distribution is taken on May 24th and used to pay funeral expenses, oh my God, legal responsibility for payment of any income tax owed on the distribution belongs to the deceased customer's children. D. I don't know if Knopman had somebody say they seen something like this on a debrief. I have had people on debrief tell me they do get more than one question on what happens when somebody dies with an IRA. So maybe that's why this seems to be a little heavy. And some of these questions I think this one's a little obtuse, but I'm sure Knopman has some reason for including it in this practice test. 52, what type of distribution may be taken by a 35-year-old 401k plan participant to cope with a personal financial crisis? Yeah, that would be a hardship withdrawal if permitted by the plan. So, depends on what 401k you have, plan you have. I told you, you really got to know the difference between closed-end and open-end companies. Closed-end shares all the following features except very testable. No, they have a fixed number of shares. That's very testable. They offer common and preferred and debt securities. They certainly can, and that's a testable distinction. Open-end funds cannot. So one closed-end fund is called the Mexico Fund, MXF. It trades on the New York Stock Exchange. The Mexico Fund chose to, they could issue preferred stock and promise the preferred stockholders 5%, make additional investments in Mexico. If the Mexico Fund chose to, they could issue debentures, promise investors 7%, take the proceeds, make additional investments in Mexico. Open-end funds can only have one class of equity, common stock, period, full stop. Now, be careful, RTFQ, read the full question. RTFA, read the full answer. I didn't say that open-end funds can't own preferred stock, can't own debt securities. I said they can't issue them, whereas a closed-end fund can. All this is very testable. They can be purchased on margin. They can be purchased on margin. They most certainly can. If I want to buy the Mexico on the margin, I certainly can. Multiple classes of common stock. There's no such thing as multiple classes of common stock. I mean, there's such a thing as an idea that you would have different common shares in a mutual fund, A share, B share, C share, but the answer is D. Which of the following securities cannot be transferred through ACATs? And again, one of these things is not a security, and it's annuities. Annuities don't work going through ACATs. Under which of the following circumstances a variable annuity suitable as an investment option for an IRA? Oh my goodness! Right away, I'm saying, oh man, I don't like this at all. Because why would you put a variable annuity that already has the tax deferred wrapper around it into an IRA that already has that. So I don't like it. Let's see what my choices are here. If the fees charged for the variable annuity are less than other investment, no, I mean, it still wouldn't make sense. 50, A doesn't make sense. B, it is never appropriate. Now, this is where, Dean, I think I'm an RTFA here, but boy, I'm on the track of saying it's never appropriate. But, never is kind of harsh. So let's just see. It's never appropriate to include a variable annuity within a tax qualified account since the variable annuity already benefits from tax deferred growth. I like that one a lot. If the variable annuity offers a unique benefit that cannot be obtained through other investment options. Well, that sounds, sounds reasonable. I like B and I like C. Variable annuities are generally suitable. No, it's either B or C. It's either B or C. Yeah, I'm going to go with C, even though I think B is more likely what your compliance officer is going to say, right? What I'm thinking here is that like maybe you can annuitize and turn it into an income stream that you can't outlive. That's kind of what I'm thinking. Oh, looks like we finished, I guess. Boom. Done. Okay. Well, thank you so much for our friends at Knopman. I've asked them to, provide us with as much content on a free look basis as they're willing to do. I would imagine if you're taking your 6, your next leg of your testing journey would be a 63. And we have a playlist for that as well. This will be in the 6 practice test playlist. And hopefully maybe we can talk to Knopman, our friends at Knopman, to give us a 63. And I would imagine some of you are going on to a 65 as well. So, your testing journey will either conclude with a 63 or following a 63 with a 65. So hope you found that helpful. Remember, inch by inch, your series 6 is a cinch, yard by yard. Your series 7 is hard. And I will see you the next time, my friends. Bye-bye.